Hope everyone's out there enjoying some sunshine or some good weather. It's nice. Here I am in Portland, Oregon, and it was sort of hard. I was in San Diego last week, left Sunday, and it was a glorious day down there, and got back, and it was just Monday, Tuesday here was chaos. But all of a sudden, it's a beautiful day for the next few days, and Northwest is certainly in its glory. So it's 10 o'clock. We are going to get started. It looks like we've got a mere fraction of the people signed on that are signed up for the class today. We're going to have some fun. First time I've done this class. I did one similar a couple of years ago. We're going to be tackling some issues that are very pertinent, relevant to today. And if you've got questions, you can post them on the side, but probably get them to us electronically. If you've got them, we'll address them offline later. Don't have time to take care of it. If you are in Oregon and you would like CE for real estate, we're able to provide that 1 hour. And you can reach out to cmore@1031exchange.com for that. Something I'd like to say is if you've got ideas, questions that you'd like addressed on different topics, if you'd like to see some content on our YouTube channel, take a look at our YouTube channel just type in 1031 Exchange Equity Advantage on YouTube. You're going to find hundreds of videos up there on everything from 1031 to charitable remainder trust, Delaware statutory trust, even selling your life insurance contract. David, why would you have a video on selling your life insurance contract? Well, I've been doing this for almost 34 years at this point, and lots of people come to me looking for sources of money to go do different things, and that's just another source of funds to go do things. And a lot of times people just let their life policies lapse, and that's just throwing a lot of money away. So we probably all seen ads for companies buying those things. Just know that it's something that's an option out there. If you look at a charitable remainder trust, once again, that's something that's it's sort of has nothing to do with 1031. Why would I have that? It hurts my 1031 business. Well, no, it doesn't, because we want you to look at us. We're not an accommodator or intermediary. We're actually a facilitator, and we're really about where you want to be in 2, 5, or 10 years, not about the transaction. It's not the deal, it's the destination. And we want to make sure that you're aware of everything out there, all the options, get where you want to go. And sometimes that's a 1031 channel, maybe it's not. If you look at a qualified opportunity zone, for example, that's a nice fallback. If you got an exchange, the opportunity cost of the exchange is you've only got 45 days from settlement to find what you want. You got 180 days to get it done. Maybe you don't want to buy that stuff now. So that QOZ or OZ is an opportunity to sort of salvage some of that. It's sort of like a Roth IRA. You got limited deferral into it, but you hold that thing through maturity. It's going to give you some wonderful benefits. It's like I said, that investment's sort of like a Roth. It's going to be tax-free on the growth on that thing. And just for future context, this is February 26th of 2025, and I understand that the Trump actually the 2017 tax reform has been extended at this point. It's working its way through our Washington, D.C. friends, and we'll have a little bit more guidance going forward on where we're headed. But like the QOZ stuff, it looks like that's going to be extended. There's a variety of things that are going to be extended at this point. Stay tuned for more details. If you're not on our newsletter, please sign up for that. If you're checking out our YouTube stuff, like and subscribe to that stuff. It really helps us out. And once again, if you've got an idea, you got something you want more information on, reach out, let us know, and we're going to create that content. So we got a lot of stuff to get through. We're going to get started right now. It's an interesting time in the real estate market. I'm really at a point where people are still crying about interest rates, and I guess my advice is, hey, it is what it is. And if you look at in historical context, the interest rates are really, I would probably argue, about where they should be. So you can either dream about something else and dig your head in the sand and hide from it, or you can deal with it. So we're going to talk about a few different topics that come up. We're going to talk about phantom gains, which is something that I think could be coming up. But I like to see with the diversity comes opportunity. So uh, knowledge provides opportunity. So you don't know what you don't know. Ask the questions, and really it's about making transactions work these days. And to do that, what's the old saying about planning? Those who fail to plan to fail. So really look at this stuff. 1031, unfortunately, through the years, it's over 100 years old at this point, but really since let's say 91, when the guidelines were sort of firmed up, it's really gotten to be sort of an afterthought for a lot of people. Oh, it's a trend. We'll just deal with it at escrow. Well, that's not the way to look at it. You've got to understand that 1031 is something you've got to plan to do, and really take the time. And you're really doing yourself a disservice not to plan these things out. Take your time to look at what those options are moving forward and understand those options, really. So we like to say you've worked hard for your money. We work hard to keep it yours. And that's what this next hour, I say hour tongue in cheek. I've got more than an hour. We're going to get through it. Hopefully you can hang on a little bit over that time. And we're going to get you a lot of good, valuable information. I want you to look at this process as something that's going to provide opportunities for you, and don't just sit and look at it as something I'm going to have to do a close. Understand that sometimes a conversation I have, understand that our firm also works in the qualified money world. IRAs, 401k plans. We've got a sister company, IRA Advantage. And one of the things that happens in that space a lot is we'll establish the new investment accounts, for example, and it doesn't really matter if we're talking 1031 or IRA 401k, or even what we do with rollover business startups in the qualified money space. We don't sell investments. We don't provide investment advice. We're going to listen to where you are and where you want to go, and we're going to try to create the investment vehicle to get you there. And if we're talking in a taxed world, we're going to look at 1031. If we're looking at the qualified money world, we're going to look at 401k plans, self-directed IRAs, rollover business startups, those things. And just understand that we're in a unique position because we deal with a lot of different topics day in, day out with those companies. We're not just closing a transaction, acting as an accommodator or intermediary, holding your money through the transaction. We're really looking at these things. People come to us all the time. Builders, developers come to us. Other investment providers come to us all the time, looking for ways to make things happen. And that's what our specialty is really taking a look at those transactions, and we want you to look at us as an asset to your team. And when I talk about your team, I would say probably in today's world, one of the most important people on that team is your tax counsel. Good tax counsel is critical, because a lot of times, I would say a lot of times it's not a question whether we can or can do something, it's how we're going to get it done. And that may require some tax input just to make sure that your tax people are comfortable with what's going on there. Because if we're in a situation where it's sort of a gray area, you can either move forward, and if you were to be audited, you're going to have to answer those questions. Good tax people are going to be sitting there telling you to be quiet, and they're going to be answering those questions and say, hey, this is why we did what we did and how we did it. And that's an entirely different situation. So I think with the complexity of today's world, tax people are really essential. Good brokers, real estate brokers, good closers. I mean, through the years, I've got title escrow people that will do transactions all over the country because they get stuff done. All right, they understand it. When we're looking at good tax and legal counsel, you're not going to pay somebody to learn on your behalf. You want to be working with people that understand this stuff, and you're paying them for advice. Good finance people, obviously. I mean, we're in a world right now where the interest rates where they are, the valuation of property, we've sort of stagnated there, or maybe in some cases values have gone down a little bit, and especially in our area. If you look at Portland, what's going on here, you sort of got, there's an article last week in the Tribune talking about the doom loop. But you look at what the government is doing and rent control issues and what they're doing, and it's really disempowering the investors and eroding the values there. So imagine if you're dealing with single family rentals, for example, You got 10, 20, 30, 40-year money on those things, those loans. If you're looking at institutional investment, maybe you're looking at 7-year. Well, think about how long the market's been going up. And there's a lot of people in the market that migrated out of single family houses and have gotten into bigger institutional properties. They've never seen a down day. You think about the market turn since the last recession, it's been a huge run up. And now they might be sitting in a situation where the property might have gone down in value. The interest rates change everything. And now they're having to refi a property, and they can't do it without injecting cash. And they might, we're going to talk about phantom gain a bit, but they might be in a situation where they're trying to refi and they can't get the refi. They're trying to sell, they can't sell. And they don't understand that a foreclosure could trigger a huge tax consequence via phantom gains. So when you're looking at this stuff, really look ahead and work to get where you want to go. Don't just sit there and sort of say, woe is me, and say, well, the market's bad. And like I said earlier, with adversity comes opportunity. You got to find that opportunity. Stay in a positive mindset and look at those options, ask the questions, and then work to get where you need to go. Don't sit there and wait for things to happen to you. Try to infect those changes, get those changes going. All right, now if I can get the slide to go. See, I didn't plan ahead. All right, here we go. So this is just a little bit about us real quick. 1991, my brother and I started the company, and we were blessed to have a mentor that really thought outside the box. And I've just got a story to tell real quick. And he told the story to us, and I had to give him a call this morning and talk to him, because it'd been a bit since I talked to him. And he taught my brother and I investment philosophy, and then ultimately taught us the exchange business. And this is just sort of the way he thought about stuff. So he told the story of an apartment complex in the Bay Area. This is years ago. We won't go into dates, but this building, it couldn't get populated. And he's like, what are we going to do with this building? How are we going to get people into this thing? And it was one of those classic courtyard buildings with a pool in the middle of it. And it's just Ron, his mind is just, it's different. I just love it. And it's always fun to talk to him. And so he's like, what can be done with this building? And he told the story of the people that were running it, owning it. And he said, okay, hey, we're going to make it clothing optional. And as soon as he did that, he just filled the whole place up. So, you can't look at what something is, think about what it can be. And that's just a crazy situation, crazy scenario. But I think in today's world, there's a variety of buildings out there sort of languishing, and it might be a dead use. Well, does it still have to be that use? And yes, making changes is always hard, but look at it, and it's always the highest best use. We had a big lawsuit in the last couple of years about property valuation on stuff. You might think of a certain property in Florida that was the judgments were talking about a valuation of 18 to 20 million, when it was more likely worth about $1 billion. And it's a highest best use for things. It's going to be different for one person than another, and really just take a look at it. Don't get stuck with what it is. Think about what it can be, and back to the opportunities and solutions. So we're in a world where a lot of times 1031 is thought of as an afterthought, and it should not be that. We consider ourselves facilitators. We take an active role in the process. We do more than just hold your money. And if you've got an idea on something, call us up. With AI and everything else out there, nobody wants to call and talk. They want to text, they want to email, but how do you get things going? And how do you really find those solutions? And we really enjoy partnering with our clients and helping them find a way into what they want to do, out of what they don't want, into what they do want. And that's what 1031 is. It's not a tax or legal decision. It's purely an investment decision. And I started to say earlier, sorry, I sort of free speak on stuff, but when I'm looking at IRA 401k clients, a lot of times they'll establish the account, but they won't fund it. And I said, well, gee, why haven't you funded it? You can't buy anything with it until you fund it. And they said, well, gee, I've got these losses. I don't want to realize the losses. I said, well, you've got the loss. Whether you realize it or not, it's there. So the bigger question is the thing that gave you the loss the best course forward, or are you better off getting rid of it, pitch it overboard, go get the new thing that's going to make you whole faster, move on? And the same thing, your real estate's sort of considered illiquid. A stock, you want to sell it, you sell it. But real estate, you got to find a buyer for it. And there's always that opportunity, right? There's an opportunity cost of the exchange, and that you got a finite period of time to buy stuff, but you also have to look at what you've got, how you got to where you are today. And there's a building that's downtown Portland, a big condo, wonderful complex, but it has huge HVAC problems. And I was talking to a client that's been a broker that's been a client of ours years ago, and she refers us stuff. And she's talking about the assessments for this building just to fix the HVAC system are really astronomical. The HOA and what they're wanting everybody to pay into it. And she's like, oh, I really don't want to sell it now. I can't sell it because I bought it for this, and it's only worth this today. And I'm going, well, look, what's the time horizon to make this thing work for you? You've got this loss. It's there. Is that investment the best thing going forward? Or are you better off just take the loss, get rid of it? You don't have to do an exchange. You got a loss on it. Now you got money to go do something and make it work for you going forward. So 1031 is not always the right thing. But the great thing about 1031 is that you choose to pay the tax when you choose to pay the tax. If you can exchange, you can exchange until you pass away, swap till you drop. Heirs get a stepped up value and never have to pay the tax. Or you can look at it and say, well, gee, if I sell it this year, my Wall Street portfolio is done great. Everything's done great. If I sell this year, I'm going to have a big hit. Well, maybe next year things change, and you can offset the gain on the property with losses elsewhere. So it's always, it comes back down to coming into these transactions, understanding on a sale what your tax consequence is going to be, and understanding the opportunity cost of that transaction, where you're going. But that tax person is critical. So I'm going to tell you, my mentor said, hey, before I ever buy anything, what am I going to make? How am I going to make it? When am I going to make it? If I can't answer the questions, don't buy it. And then you're along this path. The world throws curveballs at you, but think about what you have. And the other component is you think about where you are today. If you just, pile up all your pennies, all right? So every property you've got, all the equity in all those properties, if you look at each property individually or the overall portfolio, what's the ultimate ROI that you've got on this thing? If you say, okay, I'm here today, I want to be here in 2, 5, or 10 years, what's the ROI I'm going to need to get to that point? You take that ROI, shove it against what you got right now, and if those things aren't performing, you probably ought to get rid of them and move on to something else. The other thing, when we're talking about flipping stuff, it's dealer property. You got to look at the tax consequences of being a dealer versus an investor, and we're going to talk about all that. All right. Why exchange? Been talking about there's opportunity cost. Sometimes people come to us and say, well, hey, I'm going to have to pay the tax at some point anyway. Why not pay it today? Well, every dollar you pay to Uncle Sam costs you 3 or 4 in acquisition. Think of loan to value. So if you save, a dollar, if you buy a property at 75% loan to value, maybe you got 3 or 4 more to go buy something. So think about every time you sell, every dollar lost to tax, what good does that do for you as opposed to keeping things going forward? So we'll talk about basis and gain in a few minutes, but the exchange is really a points-free, interest-free loan from Uncle Sam for as long as you choose to take it. And if you want to look ultimately down the road, at least in the way the law works today, and this is, fortunately, if you look at last fall, election day, if the other side had won, we were looking at caps on 1031. We were looking at elimination of the stepped up base. We were looking at a whole, I'd be presenting a totally different presentation today than I am, because it would have been a different world. But today we still got swap till you drop there. We've got a variety of things that are there. There's no cap in the value of exchange in a given year, and you're free to go do what you want today. And once again, for future context, it's February 26th of 2025. But hey, 1991, I'll never forget. There was a guy in a presentation, and I remember the argument. One of the guys that worked for me at the time, he's talking to this guy and he's like, well, gee, it's patriotic to pay taxes, right? So, I don't like 1031. 1031 is not really fair. And a lot of times I'll get that argument from Wall Street. Say, well, we don't have 1031. Yeah, but you got trillions of dollars in IRA 401k money, which is the same thing. Okay. So don't talk to me about whether 1031 applies to that arena. 1031 is like I said, an IRA 401k for real estate. But the guy talking about, well, hey, it's patriotic to pay the taxes. I think it's not fair. And I would say 1031 is one of those, sort of tax loopholes that anybody can use. I mean, the cost of an exchange is nothing. But if you look at it, and back to that patriotism comment, I would argue the most patriotic thing to do would be to exchange, build that estate to a huge number. And then if you feel patriotic, sell and pay the tax at that point, you're going to be paying way more. Or swap till you drop and you get rid of it all. So why are we doing this? Why do we even talk about an exchange? Well, an exchange is going to defer gain. Gain has, really nothing to do with profit. Gain has nothing to do with net equity. Gain is simply the adjusted sales price minus the basis. The basis in the property is what you paid for it plus capital improvements minus depreciation. Now, the purchase price, and I thought I changed this on this. I need an asterisk on each one of these things. So the purchase price depends on how you got the property. If you pulled money out of your pocket, bought the property, that's the purchase price. If you inherited the property, the purchase price, you got a stepped up basis, current market value, the date you inherited. That would be the quote unquote purchase price. If I were to gift you a property, your quote unquote purchase price would be what my basis was. All right. From the time you get that thing. If you do an exchange, you got a basis carry forward. If you, let's say pre-1997, you had the old 1034, the old residential rollover, that was a basis carry forward transaction. 1033, involuntary conversion. If the city, county, state, federal government, somebody comes to you and says, hey, I'm taking your property, they're going to give you quote unquote fair market value, and you're going to have 1033 to work with. Basis carry forward once again. So it depends on how you get that thing, what that initial number is. So from that purchase price, you're going to add to that number capital improvements. Now, when I talk to people every day, they're saying, okay, hey, you bought it for this. And during the time you own it for 10 years. I know you put money into it. So what did you do with that money? Did you capitalize or expense it? Capitalized improvements increase the basis. Expense items you wrote off. So they say, well, I did this, 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 and this. And I say, okay, did you write them off? Oh yeah, I wrote them all off. Okay, that was expense items, didn't impact the basis. Depreciation. Okay, depreciation's not an elective situation. Now, I had a client the other day call up a situation. They're giving up a fourplex. One unit is their home. Another unit is the client's father living in it, and so he's paying rent on it. So once again, that would be considered investment. And then two that are pure investment rentals to other people. So we got a fourplex selling. We've got one asset with allocations 10 or 121 from the primary residence and 1031 for the other units. Now, let's say the dad's in this thing and he's not paying rent. Well, then it's a second home, and we've got a separate set of guidelines for a second home to fit 1031. It's another presentation. I'm not going to go into it today. But you've got sales. You can sell things, buy things. You can have allocations into different components of that given property. If you got a house on acreage, you're going to have the homestead portion is going to go 121, the universal exclusion. The working land is going to go 1031. As I just gave you the example of a fourplex, one unit owner occupied portion 121, which gives you the 250 individually or $500,000 exclusion on the sale of a primary residence if you've lived it in 2 out of the preceding 5 years. It's not what it is at the time of sale. It's whether you fit the 2 out of 5, where 1031 applies to what something is at the date of disposition. But you can see how these numbers change. My comment on depreciation is government's position is you should have taken it, therefore you did. That guy with the fourplex hadn't been taking depreciation. If he got audited, he's going to owe tax on the time that property was rented out. And he never got the benefit of depreciation, which once again leads me back to having good tax counsel, because they're the ones that are going to help you stay on the straight and narrow. And once again, if you were to get audited on something, you're going to be able to sit down, sit on the side. They're going to tell you to sit down, sit over there while they address the auditors. So it's really important you look at this stuff. So once again, gain is the adjusted sales price minus the basis. Basis is the purchase price plus capital improvements minus depreciation. Now, what does that mean to you? Well, first off, this slide sort of takes it to an extreme. Now, think about what I said on gain, the adjusted sales price minus the basis. When I was talking about our current market, the interest rates, and somebody in a situation where they could not refi it, they can't sell it, they lose it to foreclosure, that if the debt exceeds the basis, they're going to have what's called phantom gain, because the government's going to treat the debt as the sales price. So you could lose the property to foreclosure, and for the pleasure of doing that, you could pay up to 40% tax. Okay, that is just nuts. So you think about what opportunities you have. You've got a situation where, look, I lose it to foreclosure and I got to pay up to 40% tax, or you could do an exchange into, let's say, what's something called a zero coupon DST. And those things are typically as much as 80% loan to value. I said 89. I got to fix this slide, but 80%. So once again, it says 89. I'm going to say 80% on this. So you either come out of pocket 40 to pay tax, 40 on every dollar to pay tax, or come out of pocket 20 to buy something. You might not have cash flow on it, but when that DST goes full cycle 7 years later, you're going to have some equity that's built up and you don't have that tax consequence. So it's really a pretty simple decision to make if you think about it, if you're aware of it and you're saying, well, David, hey, I lost foreclosure. How do you deal with it? How do you set up an exchange? Well, the ownership gets transferred to us before the property's foreclosed. All right. And a lot of times we're doing that via simple assignment of membership interest in a limited liability company. But the transfer has to happen before you've got that debt relief and that foreclosure has occurred. If the foreclosure has already happened, it's too late. And by the way, with 1031, if you've got actual or constructive receipt of the funds, it's too late to do the exchange. So be aware of that too. What's the tax? Why does any of this matter? Typically, understand 1031 applies to property that's been held for investment and property that you're acquiring with the quote unquote intent to hold for investment. So if we're buying something, people that flip properties are paying normal income tax. That's dealer property that they're going to pay normal income tax in that situation, no matter how long it took them to fix the property. If we're talking about 1031, it applies to property held for investment. As far as the government's concerned, long-term capital gains tax rates today, we look at 20% Fed on appreciation, 25% tip, and this is at the top numbers, but this is typically what we're dealing with. 25% on depreciation recapture. We're going to have state taxes, could be ranging anywhere from 0 to 13.3 on top of that. And then if you're one of the lucky ones, you can get the healthcare tax, the old Obamacare that's still in place at 3.8 on top of that. So when we're looking at relinquishing a property, by the way, 1031 does not contain hold periods. We're going to talk about that in a bit. So, you could have a situation where you made a property, made a purchase, made an investment, it didn't work out, and now you're looking at a disposition, and it might be inside a year, and you could be looking at normal income tax consequences. This is assuming you've held the property for investment for in excess of a year. So the rates, this is the cheapest, the lowest tax consequence you're going to have, not figure, like I said, 40% roughly. But you could be paying, if it's normal income tax, you could be paying in excess of 50% of it. So do you really want to give up one of every $2 you made? Do you want to give up 40% of what you made? And my answer was no. I mean, when I learned how to invest, the last thing I was going to do is go pay Uncle Sam for all my hard work. So I was going to use an exchange every time I had a chance. And like I said, the exchange sometimes isn't. Sometimes we have a lot of people who just set up the exchange and sort of work through the 45 days. They pay the setup fee to buy 45 days to figure out what they're doing. Map of tax rates in today's context across the country. The gray states are zero tax. The other thing that makes the gray states typically more attractive is they're typically more conservative. You've got more ownership rights. And I'll say one other thing. If I go, for example, I'm talking to you from Portland, Oregon. If somebody comes to me and they want to do an improvement exchange in California, Oregon, or Washington, I'm going to tell them forget it, because these states all are saying, oh, we need affordable housing, we need development, da 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 da. Well, you know what? One, they're charging SDCs through the roof, and two, try to get a permit to build something. It might be 2 years before you can go build something. I've got 180 days in improvement exchange to build something. If I've got somebody that wants to go to Texas, do an improvement exchange, you're going to walk in, walk out with a permit, and we're going to go vertical on that stuff. So we can do improvement exchanges in those states very easily. But if you're looking at a transaction, and just since I'm on this topic, we handle delayed exchanges. We handle swaps, simultaneous transactions. We handle reverse exchanges where you're buying first, selling later. We do lots of improvement exchanges. So we're buying property, building it out, and then conveying the improved property. So really where you are and the political climate of that state is going to make a huge difference to what is possible for us to do. And once again, it's timing. If you've got a situation where, hey, I want to do an improvement exchange, tie up the property, go out, get the planning, engineering, permitting all set up, and don't let anything close until you're ready to hit the go button on the project, and then we can go and hit the go button. We've got 180 days to do stuff. The project doesn't have to be done, but only what is completed and constitutes like-kind real property at the 180th day is going to constitute like-kind real property. So once again, that planning thing is critical. But take a look at this map, and I would probably say that the states with the lowest state tax rates are probably going to be the friendliest ones for building things too. So exchanging creates wealth. Like I said, it's over 100 years old at this point. We used to, those of you that know me know that I love fast things, boats, planes, helicopters. We used to be able to do exchanges of all those things, businesses, all the personal property transactions we used to do a lot of collectible car stuff. It was so much fun to see what's going on in those arenas. And with Trump's tax reform in 2017, we lost all those. They were replaced with the OZ stuff and and writing off investments, offsetting the gains with write-offs of the purchase of things, so expensing those things out. And so, at this point in time, unfortunately, we can't handle those personal property items, but real property is what we're working with in these days. And you just sort of have to look at what you're relinquishing, what you're receiving, and making sure that what those things are constitute a like-kind real property, the legal definition of that. So keep in mind that even a 30-year leasehold interest or a lease with extensions 30 years constitutes like-kind real property. So be aware that those things can be exchanged. We're talking domestic property. Typically, we can do foreign to foreign, but domestic to domestic, foreign to foreign. There are certain U.S. holdings that do qualify outside the continental U.S. and Alaska and Hawaii. Not going to cover this slide much other than to point it out. You've got it for future reference. By the way, the slide deck will be available for you for future reference. And this is just that situation where we're talking about 121, the primary residence 1031. Now think about real quick, just the universal exclusion, which gives you 250 or 500 exclusion on sale of a primary residence. That thing was put in place in 1997. Think about what a house cost in 1997. Think what a house costs today. It's just crazy they have not increased those numbers. I'd say it probably needs to be $1.5 million, $2 million these days. But think about the number of people that sell a home today with gains in excess of millions of dollars, let alone the 250 or 500. So that thing needs to change. And what's crazy, I never hear any political figure talking about it. I just don't understand why they haven't addressed it. But that's the way it is. Something to be aware of, maybe during COVID. I mean, COVID's been a while, but you think about what happened to the working world in COVID, and a lot of people are being forced back into the office today, but you might have moved your home, you might have put a home office together, and after you did that, your tax people might say, well, gee, now you're treating a portion of your home as a home office. If you sold your home and you're still considering that portion of your home as a home office, that home office needs to be exchanged. It's not a primary residence at this point if you've been treating it as a home office for more than 3 out of the last 5 years. So just be aware of that. The reason I said 2 initially is because to qualify for 121, it has to fit, the use of the property has to fit that 2 out of the preceding 5 years. So you can cease to use something, and keep in mind back my comment on 121, we have lots of people. There's reasons to convert a home into an investment. There's reason to convert investment to a home, and we can do both those things, and we do both of those things all the time, and it just requires seasoning periods. So never say never. And contrary to popular belief, the code does not have required holding periods outside of a related party exchange. Basics of the exchange process. If we're talking about retirement accounts, I'd say, hey, there's 2 different things we got to deal with. 1, what do you want to buy? And 2, who are you transacting between or for the benefit of? 1031, I've got 4. All right. And if you go on YouTube, type in 1031, you say, oh, the cornerstones, maybe that's me coming up saying that. But, people say, well, the 5 things that have to happen, the 10 things that have to happen, the 2 things that have to happen, whatever it is. This is my world. I like the old keep it simple, stupid, KISS principle. So I'm going to break it into 4 contexts. 1, it's got to be an exchange. You're going to give something away. You're going to be giving something back. If you look at what ultimately you do when you engage us, okay, we facilitate the transaction, but really you're giving us something and we've got to give you something back. You're going to give us what you don't want. We're going to sell it. You're going to tell us what you want. We're going to buy it and we're going to give it to you. Now, in today's world, the deed goes directly from you to the buyer, and then on the acquisition side, straight from the seller to you, unless we're engaged with a reverse exchange where we might have sequential deeds, or an improvement exchange where there will be sequential deeds. But typically, you're just going to give us something. We got to give you something back. All right. The items relinquished and received have got to be a like kind. For total deferral, we need to satisfy what we call the napkin test. We're going to go into details on all these slides. And then finally, we've got to have continuity of vesting. And that just simply means the person that gave us something is being giving something back. All right. And once again, that relinquished and replacement property need to be held for investment at the time of disposition and the time of acquisition, but they can be changed. The use can change over time. So as I said earlier, we deal with swaps. So a swap would be you've got something, I've got something, they've got the same value and equity. You want what I have, I want what you have. That's a simple swap agreement. That's a one-to-one transaction. Exchanging in today's world typically are a 3-way accommodated exchange. Like I said, we treat ourselves differently. We're going to say we're facilitating these things. But as I said, you're basically paying us a fee to step in the middle of the transaction and turn that sale and purchase into an exchange for you. All right, that's the delayed exchange. And you're going to have 180 days from the date your first relinquished property closes to the date you've got to be done with the transaction. Reverse exchange means we can buy first and sell later. An improvement exchange means we're going to buy something, build it out. Warehouse transactions mean that we might be receiving. If you look at a purchase sale agreement, it doesn't say total cash paid for something. It's total consideration. The consideration could be property. It could be a car. It could be a boat that's being used also in those things. Now, obviously, a car or boat's not like kind. So if you actually keep those things, you're going to have a problem. So what happens is those things would be given to us just like the cash is given to us. Cash is boot. Cash is not like kind. So when those things happen, we sit on them until we use them somehow. We could use those things in acquisition, replacement property. We can sell them and then have the cash complete the transaction. If you've got a property, you might have somebody swapping a couple buildings for a larger building and then some cash coming in too. And you don't want those buildings. Well, those buildings would be deeded over to us. We're going to warehouse them, get rid of them, or we're going to use them to go buy the replacement property. We don't want to give them to you and then have you sell them and then throw them back into the transaction because you held them for resale. So those are warehousing examples of warehousing transactions. We also do what we call blended transactions. So a blended transaction, I'm going to write a note right now because that needs to go on the slide too. A blended transaction is a combination of a delayed exchange and a reverse exchange also. So it's possible to, if you're giving up a portfolio of properties, and let's say that you have, I'll just give an example, a real example we did years ago. A good friend of mine, a real estate broker, very successful real estate broker. She's sort of working in the institutional TIC world today, but she worked in the bakery world before she got in commercial real estate. And her baptism into 1031 was she met these 2 brothers, and they had 8 different properties they wanted to put in one. And this was her first exchange. And she didn't go in the residential world. She went straight into the commercial investment world. And that was her first client, first closing, selling 8 properties, going into one. We got, honestly, I can't remember. It's been so long these days, so long ago now, but I don't remember how many of them sold before the purchase had to happen. But what we did is anything that sold before the purchase had to happen came in as a delayed exchange. The balance of those properties that had yet to close, we used funds from out of their pocket that were representative of the proceeds, net proceeds from those future sales, and they came in via reverse exchange. So we had up to a full year. So you had 180 from the first sale to make the purchase, and from that purchase we had 180 to sell what was left. So we combined a delayed exchange and a reverse exchange into one property, and that was 8 different properties that went away to make that one purchase. So like my wife likes to say, anything's possible, and you just got to plan this stuff out. So those sort of a menu of options that are out there, and that's what's fun. Like I said earlier, I was talking to my one of my mentors this morning, and I just said, hey, thank you for all you've done, and I just want you to know, all these years later, you're still living on in this company, because just look at it, and the only dumb questions you don't ask. So if you got some puzzle you're trying to figure out, give us a call, talk to us, come in if you're in the area. We're always happy to see you, even if you're working with somebody else, by the way. This slide's critical, all right? So a lot of times what's happened recently is, with the market where it is, it's tight, financing might blow up, something might happen, you might have a sale pending, the thing doesn't work out, and somebody said, well, just go ahead and buy the replacement property if you got the ability to do it, and then when your property sells, we'll do a reverse exchange. You cannot own both the new property and the old property simultaneously. That's part of RevProc 2000-37 that covers reverse exchanges. That came out in 2000. All right. So I'm going to say this again. You cannot buy the replacement, own it at the same time you own the relinquished property. You have to structure the exchange. So if you want to do a reverse, it has to be structured before you close. And any exchange requires that you set up the exchange prior to close. If you sold the property, never touch the money. The money's sitting there in escrow. You say, well, hey, I never touched it. It's still in escrow. It doesn't matter. Actual or constructive receipt triggers tax and eliminates your ability to the exchange. If you buy a property without us, that property you're now the proud owner of. We cannot exchange you into it. Now, could we exchange you? Could you buy a partner out of a property? Yes. And I got to be careful when I say partner, because we cannot exchange into or out of a partnership interest. So if you own a property via a corporation, I'm sorry, that's a problem. Okay, C corps, S corps. The reason nobody uses them today is just pulling properties out. If you got partners in there, anything you pull out of those things, you're going to go basically market to market. If it's a limited liability company, we can do contributions, distributions. You get people in and out. There's a term called a drop and swap or a swap and drop, and that's about partnership transactions. And we'll probably talk a little bit more about that later. But the idea is, if you've got partners in a property, and you own that property via limited liability company, and somebody wants out and you want to exchange out of something, buy their interest out, you drop them out, tenancy in common, then they season that property as an investment for a period of time, then you could exchange into that interest, and it's going to qualify. They have the ability to exchange out, you have the ability to exchange into a property that you already own the balance of. If you're buying a tenancy in common interest, you cannot buy into a membership interest in the limited liability company. So once again, planning is critical, and you got to understand what's going on, seasoning periods in between these different changes of ownership. Like kind, all right? So one, it's an exchange. You give us something, we got to give you something back. Like kind refers to the nature of the investment or in the form. Any real property that's been held for investments, like kind with any real property acquired with the intent to hold for investment. So if we look at this sort of diagram here, land's going to be like kind with a rental house, commercial properties, vacation properties, multifamily, single family home, all those things would be fine. A 30-year leasehold interest in property is also going to qualify, okay? How about a place at the beach to retire into? That's possible. You just got to acquire the property, hold it as an investment for a period of time, then move into it later. Be aware that you can't sell that property within 5 years of acquisition, even if you've been living it for 4 years, and use the exclusion. Okay, it's going to be a fully taxable sale. Even after 5 years, you're going to be subject to something called the Housing Assistance Tax Act. All right, the Housing Assistance Tax Act is going to give you a proration of Section 121, the universal exclusions, 250 or 500. All right, you're never going to get the full 250 or 500. You're going to get a proration of that, and the proration is based upon the time the property's been held with qualified versus non-qualified use periods from April of 2009. So if you got information, you got questions on it, one information, once again, give us a call. So 1, it's an exchange. 2, what's relinquished and received for like kind. 3, we need to for total tax deferral. I want to stress this, by the way. 1031 is not all or nothing. You choose to defer what you want to defer. All right, every dollar you spend over your basis represents tax deferred gain. If you gave up a $500,000 property with a $100,000 basis and you went out and bought a, let's say a $400,000 building, you're going to defer the gain on the difference between the 1 and the 4. You're going to have exposure on the difference between the 5 and the 4. And that's not entirely accurate, because if you sell and it's at 5, you're going to break out the broker's commissions, title escrow fees, tax and legal fees, hour fees, and maybe on 5 you net 460, 470. That would be the bullseye number. But if your basis once again was 100, if the perfect replacement was 200, you'd defer the tax on the difference between the 1 and the 2, and you'd have exposure on the difference between the 3 or the 2 and the 460, 470, whatever that number is. So, and also, once again, this is tax planning. So first thing you want to do when you contemplate a sale is talk to your tax people. Okay, say, hey, I'm considering the sale of this thing. What am I looking at tax-wise? Talk to your broker, get a net sheet, take that to your tax people and say, okay, hey, let's do a breakdown and figure out what kind of gain it is and what else is going on in life. Good tax people. When are you going to talk to them? You're not going to talk, well, you're probably going to talk to them April 10th. You're probably going to talk to them April 14th. You might talk to them April 15th, but don't let that be the first time. Talk to them before the year ends, because maybe you had an exchange that you did. Maybe it triggered some gain, but maybe you have some stocks that can give you some losses, so the losses can offset the gains. So we're not just talking about you and your property annually. You're looking at what is there and your ability to, in times like we're in. I mean, those with the gold are sort of, the old rule with those with the gold make the rules. Well, those with the gold are going to be the people that make things work too. They can be a solution to people. And that's, once again, when we're looking at our IRA 401k clients, they're coming in with cash, typically buying things outright unfinanced, and they can be a solution for someone that's got a real problem lurking in the finance world or phantom gain world or whatever it might be. So just, really look at your global tax consequence annually. Talk to your tax people before you list a property. At least, before you sell it, at least before year's end, worst case, and then look at what you've got going on. Take advantage of your financial advisors too, by the way. Look at what you've got and say, hey, Susie, I've got this gain, a big gain on this piece of property. Is there anything I can sell in the Wall Street world that can mitigate some of the tax consequence of this thing if you didn't do an exchange, or maybe you did a partial exchange? But it's not all or nothing. All right. Now, the other thing I want to really stress here, big issue, because think of the finance world, loan to value, it's decreased, right? So if you look at debt in a transaction, one of the biggest fallacies in 1031 is you got to replace debt. That's totally wrong. You don't. Okay, debt can go away 2 ways. One, by going down in value, triggers tax because you went down in value. The other way debt's going to go away is by adding cash to the transaction. So it's very common for our clients to put money into a transaction these days to get a deal done. Now, the other thing is, if you said, hey, David, I want to pull some money out and go take a trip or buy a car or whatever it might be. The boat, I need my boat. That's fine. Whatever money you pull out, you're going to pay tax on it. Like I said, it's not all or nothing. Well, another option, and okay, this is something that really bothers me. Okay. Think about this. And I had this conversation yesterday. So I had a conversation with a client, and his brother's a partner in the property, and our client wants to buy his brother out of the brother's interest in the property. He wants to go away. Well, the brother's thinking he doesn't want to do an exchange. He wants to just put the money into some Wall Street stuff. And I said, well, okay, so what's he looking at Wall Street? What kind of yields he looking at? He said, oh, like 4.5 to 6%. I said, okay. So think about this. He sells the property, he loses 40% to tax. 40% of his gain goes away to tax. Take that number, net of that tax, and now plug it into those Wall Street investments and tell me what it takes to make 4.5 to 6. It's not that. It's not going to work that way. On the other hand, what's an option? Because for my client to do the exchange, his brother also, so for him to buy his brother, so he's going to sell some other properties. He wants to buy his brother out of this one property because he likes the property. If the brother does an exchange, so if they each do exchanges, there's a related party transaction, they each do exchanges, each of them would have to hold their respective replacement properties for no less than 2 years to have the exchange work. All right. If the brother doesn't want to do the exchange, just wants to sell, pay the tax, and go buy these other things, he's going to, for that 4.5 to 6, he's going to lose 40% to tax. And what's he actually got to make to get 4.5 to 6? So the option I say is, look, instead of having to just sell, pay the tax, let's do a DST investment. Let's have him do an exchange into a DST into what's called a 721 UPREIT. The 721 UPREIT. So what happens is he defers all his gain into the Delaware statutory trust investment. That's held as such for, let's say, 1 year to 2 years. At that point, you utilize the 721 UPREIT. His interest in the DST is now converted into shares of a REIT. Okay. Now, the beauty of that is, as you sell those shares, you just choose to pay the taxes you want to pay the tax. So you can offset gains and losses by selling shares of the REIT. Or the thing that people don't understand, the wonderful, amazing thing about it is that typically when you sell something, you're going to pay tax through the gain until you get the basis. All right. A lot of times people say, well, hey, when I bought the property, I put 100 into it, I should be able to get the 100 out without tax. Totally wrong. Okay. You're going to pay tax through all the gain until you get to the 100, and then you get that 100 out with no tax at the end of the day. Going into the 721, your tax consequences get flipped upside down. You can sell through the basis with no consequence until you get to the gain. Then you're paying tax on the gain. So it's an incredible estate planning tool. And your financial advisors, some of them, if they've got access to DSTs and 721s, you can talk to those people about it. But the other option is, depending on how much money they want to use in Wall Street, I'd say, look, if the property that you're selling is not on the market yet, do a cash out refi before you ever put it on the market. Hold it, I'd say, in that situation, maybe a year in advance. Otherwise, it could be looked at as a step transaction. On the other hand, if you bury all the money into a replacement, and maybe you're buying 2 or 3 properties, you put the debt on a couple of them, buy one outright. After you've closed on that one that you bought outright, do a cash out refi of that property. That money's not taxed. Now take that money and throw it on Wall Street, and you're not losing the 40% to go get your 4.5 to 6. And by the way, you're looking at the DST space, and you just sort of talk to those brokers and sort of get an idea of what kind of ROI you're going to get on that stuff too. But it might be 3.5 to 5. There are companies that are talking a lot more than that. Be very careful there. And I guess my real advice in that space right now is work with companies. There's a handful of companies that have been through bad times. All right. If you look at pre-market crash back, the last crash, we had maybe 70 sponsors, went down to a half dozen. Now I hear in excess of 100 of them. I would go to those heritage players because they've been through the bad days. They survived that time. They're going to be, able to move forward. I've got a lot of clients that are more concerned with preservation of wealth these days instead of ultimate ROI on stuff. But, ask the questions. Continuity vesting, this is the last of those 4 cornerstones. The person or entity, the taxpayer that relinquishes has to receive. All right. So if we're looking at, I made a comment a couple minutes ago about drop and drops. That taxpayer, if we're talking about a legal partnership, that's the taxpayer. A C Corp or an S Corp, that's the taxpayer. You, if you hold it directly to taxpayer. Spouses in a community property state, that's not considered a legal partnership. In a non-community property state, spouses in a limited liability company, that's a legal partnership. So you have to really be careful and plan ahead. Once again, if we're in a community property state, even spouses, you give up a property held by the limited liability company, you go out and buy a new property. If it's 4 units or less, it's typically a residential loan. The cost of capital is going to be more if you buy it in an LLC. So you're going to say, hey, David, you know, we relinquished the property in LLC because my lawyer wanted me in it because it's going to protect me. And now they're mad at me because I'm telling them they have to buy in the LLC. So you got to look at what you're doing with these things and plan ahead once again and understand that structure. This vesting, the biggest issue, biggest headache with any exchange is always going to be time. That 45-day ID period is horrible. The 180 days, not a problem typically unless we're doing build to suit, something like that. But the vesting issue is the second biggest problem we've got in the 1031 space. The 45 and 180 both start simultaneously at settlement. Just like I said, we've gone around and around, and something to be aware of: late year transactions. The code says you've got 180 days or the due date of the tax return. So make sure that you're paying attention late year. Don't file a return before you've completed the transaction. The bold at the bottom here talks about we have every year. If you're doing deals in Florida, I can pretty much guarantee you might have some type of extension. So geographically different regions of the country are going to have a situation where you got natural disasters. Unfortunately, last year we had people impacted in the Carolinas with the hurricanes. We've got issues obviously with Southern California with the fires that just happened. So you've got to be able to show that you were impacted by the disaster that has impacted your transaction. And if you're an affected taxpayer, then there may be extensions that are there, but these extensions are not elective extensions. You got to actually show that you were impacted by them. And by the way, the reverse, it's going to work the opposite. From the date of acquisition, you got 45 days ID what's to be relinquished, 180 days to get rid of it. This slide is very, very, very important. There's a term called an accommodating accommodator. You might think they're great to work with. Don't work with them. And the accommodating accommodator says, hey, gee, you start an exchange and you've decided you don't want to complete it, and you just say, hey, give me my money, and they give it to you. There's something called 1031 G6. 1031 G6 is an absolute rule. You can't, it's not an elective, you get to choose to work with. This thing is critical. The accommodator, the problem is that you can only get exchange funds out of the exchange accommodator's hands or facilitator's hands after you've acquired everything you have the right to buy, which means at no time inside the 45-day ID period. After the 45th day, only after you've purchased everything you have the right to buy. Now, if you say you're working with a company that's just going to give you the money, and you're saying, well, you're arguing with it. Well, what do you care? Because it only impacts my transaction. I'm going to pay the tax. And honestly, the government should look at it differently because, hey, if you're volunteering to pay tax, they should be happy. But, this is the law. It's not whether we choose to participate in this or not. This 1031 G6 is part of the code. So the problem is this: you might be willing to pay the tax and you don't care. But if the exchange company just gives you money outside 1031 G6, their policies and procedures are invalid. Therefore, every exchange that company does is invalid. Okay, that's the problem. So that friendly accommodator that's doing this stuff that you think so great, that's a problem. You don't want to be working with them. All right. If you don't mind not sleeping at night, fine, do it. But that's not somebody you want to be working with. So be aware in these situations. What I'm going to tell you, when you get to the 45th day, if you haven't found what you want, terminate the transaction. Even if you've turned in an identification, rescind the identification. Now, you can't rescind the ID after the 45th day, but if you're inside, rescind the ID. David, why do you say that? Because what happens on day 60 if you find what you really want? I can't give you the money. That deal is probably going to go away. So be aware, work through the transaction from the moment you list a property or decide to sell. Look at what you want to buy, work on the acquisition, find something, make the offer. You can make the offer, you can put earnest money down, do everything short of close on it. Great. But don't get yourself in a situation where you're trapped in the transaction. And worst case scenario, you ID'd something at day 45 just in case, and now I've got to hold the money through day 180, because that's not fun for you and it's not fun for me. All right, so really look at it and understand where you are with these things. Don't just ID something just in case. property ID, you got 3 different rules. So a lot of times people say, well, gee, and this is a fallacy deal too. You can only, acquire 3 properties, ID 3 properties. Totally wrong. You got 3 rules. Each rule works independently of the others. Okay. 3 property rule says you can ID up to 3 properties in value. 200% rule says you can ID more than 3 properties. Total value can't exceed 200% of the relinquished property's value. Third says you can ID more than 3. They can exceed 200% in value, but you've got to acquire 95% of the aggregate value of all properties ID'd. Okay, those are 3 totally different rules. Each has a situation that works well. And by the way, you might say, well, gee, David, I ID'd these properties, but they're no longer in the market. Somebody bought them, so I can't buy them. So 1031G6 says, I can get money after I purchase everything I have the right to buy. It doesn't matter if the property's on the market. Does the property have to be listed to be identified? It has nothing to do with your identification. So just look at what you're doing with this stuff. And by the way, when we're looking at the 200% rule or the 95% rule, back to my comment earlier, what is a property worth? And it's going to be subjective. So when you're IDing things, if you're looking at the 3 property rule, you're just going to fill out a form with us saying these 3 properties. If you're looking at the 200% rule or the 95% rule, we're going to want you to put down those values on that form. All right. So, this is just talking about 1031, the ID, and the number of properties. You can relinquish and receive any number of properties in an exchange, but the ID periods, the timing of the transaction is going to be paramount. Blended transactions, I mentioned that earlier. So we can combine in the story I gave you earlier of the brothers with the rookie commercial broker, and she was fearless and good for her, and she made a big difference there. And we took 8 different properties, and we did a blended transaction, half delayed. I shouldn't say half, but we took a portion delayed and a portion reverse and made that whole transaction happen. Notes and seller finance. All right. If you've got, maybe you're an investor and you're considering a seller carry, and there's groups out there that just, oh yeah, everything I want to buy is zero, nothing down. Robert Allen in the 70s, I think, wrote a book, Nothing Down. It was, I think, one of the first real estate books I ever read. Great idea. And when I got into in the investment world, my brother would buy whatever. If we could buy nothing down, we would. It's great, right? It's great for the buyer, but for the seller, you got to understand there's big issues there. One, you sell and carry a note and trust your land sale contract. If you've got debt on the property and or depreciation, even if you didn't receive a single principal payment in that year, you better get enough of a down payment to cover the closing costs, and you're going to be taxed on debt relief and depreciation recapture in the year of disposition, whether you got a single payment or not. So be careful. Okay, buying on a seller carry, wonderful. Selling on a seller carry, big sting to you if you're not aware of it. And by the way, if you want to do an exchange, you can't do the exchange when you receive that balloon payment down the road. And I swear this is one of those things, I feel like it's elder abuse. I've got a number of clients that are being told by buyers that they can just do an exchange when the balloon payment comes in. These buyers are coming in and they're drawing these contracts with blind assumptions, meaning they have the right to sell the property to somebody else that you don't know, and they're going to take over the contract. And they also they do these things with no prepayment penalties. So you might be sold on the idea, hey, I'm going to go get 10 years of income off this thing, and next year the interest rates go down, or that person sells, and now you're getting paid off on something you thought was going to be a nice end game. So understand that these things are there. They're prevalent these days. If you got questions on it, take a look at our YouTube channel. Just type in Equity Advantage, Seller Finance. You're going to see a video there. You're going to see me talk about this slide, and it's going to cover everything. So depending on if you're a broker and you want the seller to be aware of what's going on, or you're the seller and you want to be aware of what's going on, take a look at that video. It's really going to be helpful to you. But if you want to do an exchange and carry paper, there's a lot of times people say, well, you can't do it. Well, there's 5 different ways to do it. All right. One, that note's going to come to us at close along with the cash. I'm going to say that again. The note's going to be ours at time of close, along with any cash down payment. All right. We then have choices. We can sell the note to a third party. We can use the note to acquire note and cash to go acquire replacement property. 9 times out of 10, our client buys the note from us. And you say, well, gee, David, why? It's my note. Why would I buy it from you? What you're doing is substituting cash for the note, which allows us to complete the transaction. Now, the real thinking client is saying, well, gee, when I was going to sell it to a third party, they were going to discount the thing. And by the way, that doesn't happen. We don't sell to third parties very often these days because the discounts are so great. But back to number 3, you're going to buy the note from us. You're saying, well, hey, we're going to discount the note if it was sold to a third party. So, hey, I want to buy it at a discount. It's one of the wonderful opportunities. No, it's not, because a discount, you gave us a property of a certain value and equity. If we discount that note and sell it, that reduction reduces the equity, and you're not carrying the equity forward, which is going to trigger tax. So if you buy it from us, you want to buy it at face value. I've had people borrow money from the bank to buy the note. Okay, but you think about it, if you got money in the bank, what's it paying you? What are you getting on this note? And the other thing I would say is, when you sell and carry paper, whose paper is it? Is it the buyer's? Is it yours? Who should it represent the best interest of, the buyer or you? It's yours. Make sure it's representing your best interest. So you got to have your legal people do this thing, or if it's no trustee, escrow can do it, but make sure there's an acceleration provision in it. So there's going to be some prepayment if it doesn't go term you want, and make sure there's no blind assumptions in that thing, and make sure it's just taking care of your interests. And if you wanted to sell and carry the paper and then be done with exchanging, fine, but make sure it's taking care of it. The other thing I want to stress is, what's the interest rate on that? It better not be at what a bank rate is. All right. I mean, there's a reason that note is there. For the people that borrow money from the bank to buy the note, the cost of capital of the bank should be less than what that note's paying. So like I said, I've had people borrow money from the bank because maybe their cost of capital is 2-3 points less than what the note's paying. Maybe if it's, I've had people in the cannabis world is a 20% loan. So, maybe the cost of capital of the bank's 7 and they're paying you 20. Where else are you going to get 13%? So just look at those things and understand that it's your paper. Get what you want out of it. All right. The other situation comes up a lot these days. We have a number of transactions where financing's blowing up. Our clients 180 days coming up. And so there's a short-term note. So that note comes to us. The note's there for 30 days, 60 days, 90 days. As soon as it balloons, we've got the cash to complete the transaction. So it's sort of gap finance to get the deal done to make that transaction work. And that can be a nice situation there. And then the 5th option is partial transactions. All right. It's not all or nothing. Like I said earlier, anytime we're looking at these things, every dollar spent over the basis represents tax deferred gain. Flipping is not investing. I'm going to say it again. Flipping is not investing. Flipping is a business. You're buying a property, you're holding it for resale, and you're selling it. All right. So, one of my old lawyers, I think he's probably been retired for 15 years at this point, but he said, "Hey, David, there's no real new ideas out there. It's all old ideas, just regurgitated." And today you hear this BRRRR, it's the acronym, it's the hot topic. That's old news. All right. And it really doesn't cover the last step, which is how my brother and I got in the business, because we'd buy, we'd rehab, we'd rent it out, we'd refi, we'd hold it for a year or two, and then we would exchange out of that. Because at some point, every property, well, I shouldn't say every property, there's a whole location thing. And I've got a number of clients that have had properties, let's say on the shoreline at Tahoe, or on the beach in California, or whatever it might be. And these things are just legacy properties that really would be impossible to replace. I've got a couple of those old legacy properties in my family I just wish had never gone away. But it's impossible for us mere mortals to go buy some of this stuff anymore. But for an investment property, typically there's a reason builder developers buy things, build things out, and then turn them inside, let's say, 5 to 7 years. Because what they do is, back to my comment at the beginning, what am I going to make? How am I going to make it? When am I going to make it? And when you're buying things, think about acquiring the property. You put all this money into it, and when are things going to start wearing out? At what point do you maximize your ROI before you start having to put money back into it? And at some point, when you've got an equity to a level that the ROI it doesn't make any more sense, you've got two choices. You do a cash out refi or you get rid of that property. How do you decide between the refi and getting rid of the property? It's highest best use. Can you do anything else to maximize the value of that property? Is there a reason to keep it? Is there a reason that that property is better than that next opportunity that might be out there on the horizon for you? And that's your decision. But understand that there's a process to this stuff. There's a life to those investments. And I would say use 1031 exchanges, use the exchange, use Delaware statutory trusts and other things to leverage investments. If you just go out and say, hey, Mr. or Mrs. Smith, I want to buy your property. We all see those properties that are sitting there rotting. And you might say, gee, that thing's just falling apart. Why do they hold it? Well, they might hold it because they don't know what options they have and they don't want to pay the tax. They're tired of managing it. They can't afford to maintain it. Give them a place to go, and that's going to open the door for you. So, look at those things and really work those opportunities, giving people a place to go, offering an opportunity instead of just asking them for something. If we're looking at flipping properties in the qualified money world, the IRA 401k world, we have lots of clients that want to do that, and we might be using, instead of a checkbook IRA or a solo 401k, we might be using a rollover business startup in that situation, depending on what's going on. But even, let's say, a Roth IRA buying a property, if it's going to be flipped, it's a business transaction, not an investment transaction. And even if it's a Roth IRA, say, hey, it's a Roth IRA, don't have any tax exposure. And for those of you, unfamiliar with the term, a traditional IRA is pre-tax money growing tax deferred. A Roth IRA is tax money that's growing tax free. If you're conducting business with a retirement account, you're subject to unrelated business taxable income. You're conducting business, and even with a Roth IRA, you're going to have tax exposure in that situation. So this slide is what I look at. I look at the Clarkowski card case, 9 points used to determine dealer status. I look at it in 1031 context to see whether a property qualifies for 1031 and whether the taxpayer is going to be looking at normal income tax or a long-term capital gain as an investment. I also use this court case in our IRA 401k transactions when we're looking at UBTI, whether we're conducting business or that taxpayer is looking at an investment. And that's going to trigger any tax exposure due to the UBIT in that space. So purpose for which the property is acquired, purpose for which the property is held, extent of improvements made, frequency, number, continuity of sales, extent, nature of transaction in the property, general business activities of the taxpayer, the extent and advertising and promotion of the property or sale, whether the property is listed with a real estate broker or other outlets, and 9, purpose, the property was held at the time of sale as opposed to the time of acquisition. You can be a dealer and you can still have investment properties, all right? You can be an investor and you can have properties that are dealer properties. And you're just going to look at, if you've got a couple of these strikes against you, maybe you're not a dealer, but they start snowballing and you've got issues there. So this is just, for reference, but I think it's a great page. And I'm talking quick. I'm trying to get through this. I said it's an hour. I'm sorry if you have to go get the slide deck, but we've got a few more pages to get through, and I hope you can hang on through the end of this. So the next big fallacy. Well, the code says you got to hold it 2 years. The code says you got to hold it 5 years. One of the videos that's on YouTube that we've done is the fallacy of the 5-year hold. It's a result of people talking about 5 years. I'm going to say this a couple times right now. 1031 does not have a stated required hold period for qualification. I'm going to say it again. 1031 does not contain a stated required minimum hold period for qualifying a property as an investment property for 1031. A related party transaction has a required hold, but even in the fine print there, it states unless there was no intent to avoid tax, which look at 1031 as avoidance, deferral, but in general, and we're going to talk about related party in a second, so I won't talk any more about it, but typically, you're looking with related party transaction. That's the only thing that's in the code where we're looking at 2 years. That video I talk about is 5 years. The 5 years applies to, I mentioned it earlier, remember probably 45 minutes ago, I talked about a property acquired via 1031, converted to primary residence, sold. If you sold it within 5 years, because a lot of people thought, and there was a couple of years where you could have exchanged out, right in the late 90s, where you could exchange out of a property, acquired a property via 1031, held it as an investment, moved into it, lived in it for 2 years, sold it, and gotten the full 250 or 500, and everybody would have been happy. The gains would have gone away, and that was wonderful. It doesn't work anymore. Lots of times people come in with that genius idea. It used to be, it doesn't work. And the first thing government did was put that 5-year hold in. So if you, I'm going to say this, if you acquire a property via 1031, convert it into primary residence, sell it inside 5 years, it's a fully taxable sale. And we talked about this earlier once, but I'm going to hit it one more time. The Housing Assistance Tax Act further plug that hole, says, hey, look, even after the 5 years, you're in a situation where you're going to get prorations of the 250 or 500. You're never going to get the full 250 or 500 on a property acquired via 1031 and later sold using 121. So related party transactions. Okay, as I said, related party transaction, and you can sell to a related party in an exchange. You just can't buy from one. All right. So if you want to do a transaction, as I said earlier, that client, we talked about the DST and the 721 UPREIT, that transaction all hinges. So even though my client wants to buy his brother out of the property, he's not going to be able to do it unless his brother also does an exchange, and each of them hold their respective replacement properties for no less than 2 years. Okay. So, and by the way, the 721 UPREIT, there's going to be a hold period. You're acquiring that DST, and then that DST is going to be held as such for potentially a couple of years. All right. And so just be aware of that. If it rolled in the UPREIT, you need to make sure that, that thing's being held through the two-year time period. But that's a discussion probably ought to have with your tax people if you're doing into the 721 versus just a straight up sale where the DST obviously is going to qualify. Most DSTs are going to be a 7-year hold on that stuff. There's never going to be a set hold. If you're working with a real good company, they're always going to be watching what's on the horizon. They're going to be looking at what's going on. They're wonderful property managers. The strength of DST is obviously the company, number one, the way they're acquiring the property, but ultimately the management of the assets, and they're always looking at where they're going to be harvesting the best yield for the investors and themselves, as managers of those properties. So related party transactions, sell to related party, okay. Buying from a related party only if you and the related party are going to hold your respect, do exchanges and hold respective replacements for no less than 2 years. A few examples, we're done. This transaction, we just had people that were, this is really timely, even though this transaction was probably 20 years ago. It's really appropriate for today because it's a partial transaction and lots of people are wanting to maybe pull some money out and do some other stuff. These people came to us. They sold a $3 million apartment complex 20 years ago. That was a big complex. Today, it's not many units. But anyway, they bought $1 million. They want to exchange out a $3 million property, buy $1 million property investment house in Palm Desert. So you're saying, well, gee, David, they have $2 million. Anything you don't receive in an exchange is called boot. So they got $2 million in boot. That's a big tax hit. Yes, it is. Maybe they had losses to offset some of the gains. Maybe they didn't care. And I never make a decision based upon a client, because each client is different. I can think back through my 30 plus years in this business, and I laugh because I think one of the smallest transactions we ever did had about a $5,000 tax hit, and you're going, gee, the opportunity cost of exchange, I wouldn't do that. But our client was a CPA, and she just was not going to pay tax to anybody. So even though she was paying us in those days maybe $1,000, $1,500 to do the exchange, net benefit was $3,500. She just didn't want to pay it. She wasn't going to do it. On the other hand, I've had people say, well, gee, one guy I remember said, well, my tax is only 800 grand. I don't care. So I'm just going to pay the tax. So each is to their own. And really, you got to look out, once again, like I said, tax planning. Maybe the 800 was offset with losses elsewhere. Who knows? But everybody needs to really work and figure out, understand the liability and figure out what's going on. In this case, you look at it and say, yeah, they had boot on the difference between the 3 and the 1, but their tax basis on the property went away was 250. So they still deferred the difference between the 250 and a million. So they deferred gain on $750,000, saved them $250,000 in tax. So it's not all or nothing. Everybody's different, and give people the opportunity to get where they want to go. Second situation, this is one, once again, years ago, but I just love these things. Obviously, I've got a whole book of transactions that we've done through the years that are just, I think, great examples, and this is one of them. This is an example of converting properties. This is an example of exceeding the 3-property rule, and how many properties you can acquire, and it's also paramount to timing. Our clients, the spouses, he was a lawyer, she was a CPA. They got referred into us, fortunately, early by another law firm that was doing work for them in the transaction. They were selling a house in Los Gatos, California, $3 million in gain. They were looking at $1 million tax hit. That was unacceptable to them. So they called us up. We told them, move out of the house. They moved out of the house. They seasoned it as an investment property after the appropriate seasoning period. By the way, they got some money out of it, bought the home to live in that they wanted. They then, after the appropriate seasoning period, sold the home. They were entitled to the exclusion. They exchanged the overage. They bought 24 different replacement properties, closed them all inside the 45-day ID period. They went from $1 million tax hit to none, went from one home, which they would have lost that $1 million, and got 24 different replacement properties. I think that's just a great example of taking advantage of resources out there, planning ahead, and really leveraging the investment, planning it out, and really working to get where you want to go. Obviously, this is one of those transactions that probably didn't allow a lot of sleep until those things were all completed, because imagine buying 24 properties, getting them done inside the 45. The purpose of doing that was those properties were in excess of 3, obviously. They were in excess value-wise of 200%. So we're looking at the 95% rule, which you think about the possibility of one sale not happening and blowing up the entire transaction. So really button it down. I've got a buddy that always says, hey, if you never ask, the answer is always no. So make sure you're timing the transaction, asking for the transaction to happen in the manner you want it to. I think this is the last example. This is a curveball, all right? So this is a transaction that it hopefully entices you to look at IRAs and 401k plans and what's possible in that space. And this is a retired couple that came to us, and they said, well, hey, we've got his and her IRAs. We want to buy a mobile home park. Can we do that? And the answer is yes. And our first sort of course of action is something called an IRA LLC or checkbook IRA. So what we would have done in this situation, it was just a pure investment for them, was to create new custodial accounts for his IRA, her IRA, and then we would have created an IRA-specific limited liability company. We would have directed the investment into that limited liability company, funding that LLC. The LLC would have bought the park, okay? And they could have managed that asset from the outside. They can do the administrative functions of management. That would have been fine. But then they said, well, David, we want to be the on-site managers. We want to live there, and we want to be compensated. We need the income from it. I said, okay, well, both of those things would constitute prohibited transactions with an IRA LLC or a 401k plan. So what we did is we shifted gears into something called a rollover business startup. So instead of taking an IRA and an LLC, we took a 401k plan and a C corporation. And we took his IRA, her IRA, rolled them into the new 401k plan. We created a C corp. The plan bought in the C corp. They had to have 5%, no less than 5% personal shares in that C corp. We funded the C corp. The C corp bought the park. They got an investment. They got a job, and they got a place to live, all with that one transaction. And that is just really an extreme example of what's possible if you have people in place to get you there. End games. So maybe you're at the end of the rope, you're just done, you don't want to do any of this stuff. You can swap till you drop, which is there. 1031 into a retirement home. It's going to take time, seasoning periods, installment sales. We talked about those. Understand the tax consequences of those things and what they're going to do for you. Make sure you understand it's yours. So you want to make sure you don't have anybody able to do a blind assumption. You want to make sure you got accelerations provisions in those things. Structured sale is sort of a third party. What happens with a structured sale, it gives you installment sale treatment. And by the way, deferred sales trusts are sort of in the same world there. But what you're doing is you're looking at installment sale treatment of a sale. A structured sale is a third party assignment company that gets inserted into the transaction to assume the obligation to pay you over the term and rate that you have established with them. The 721 UPREIT is you're acquiring via Delaware statutory trust, and then after a period of time, your Delaware statutory trust ends up being rolled into the UPREIT. Those work great. Let's say we've got a few clients right now that unfortunately are terminal with different illnesses. They're all about getting their estate set up for their heirs or maybe their widow. And owning income properties today, it's a big job. So they just want to make sure their heirs are taken care of, but they also want to have some liquidity for those people upon their passing. So I love that 721 because we complete the transaction in the 721 in the DST totally deferred, and then it's held as such until it rolls into the shares of the UPREIT. And then after that's happened, if the person passes away, they can sell the shares of the UPREIT with no tax consequence. So you got the opportunity for liquidity, which in a lot of these things you don't upon passing. Deferred sales trusts, like I said, they sort of treated like the structured sale and installment sale, sort of the same arguments. I guess a word of caution on deferred sales trusts is they really have yet to receive formal approval at the highest level from the IRS. So be aware of that. And also typically you're looking at unencumbered properties and they have a floor in value. So if you're looking at that space, make sure you understand what you're working with before you get yourself, in a place where you're depending on that for your end exit game. Charitable remainder trust, if you want something on that, our YouTube channel's got it on there too. They can work well for certain people. If you've got some charity you want to get the properties to, they can help you get that thing taken care of. And by the way, they can be used for other things outside real estate. DSTs we've talked about, institutional TICs. What difference between TICs and DSTs? DSTs are stabilized asset, could be one property, could be multiple properties, non-recourse debt. Institutional TIC is typically a value add play. So you're looking at a different situation. A DST, typically the sponsor owns it, they're selling interest in it. The institutional TIC is going to be typically a situation where they've tied up the asset, filled the bucket with investors, and when they meet critical mass, they buy the property. Oil and gas. We've got a couple primarily one company I do a lot of work with, love them. Once again, February 2025, drill baby drill, which is like anything. It's sort of like crypto. Something gets hot, a whole bunch of people get in. I'm going to say this. Work with people that have been in the business. Don't just jump in with somebody that's got this bright, shiny new nickel they're selling you. Really ask the questions, understand what's going on. But I've got a company that we've worked with now for a half dozen years. They're great, really neat people, great company, and they're obviously in growth mode in today's climate. And there are certainly interests in oil and gas do qualify for 1031. So, any financial person is going to say diversification portfolio is a good thing. And I think it's a great opportunity for people. Gifting properties, another option there. At the end of the day, what do you want to do with what you got? And I had a conversation with somebody in my office earlier who was just saying, her mom wants to see, basically be able to enjoy some of her wealth with their kids before she's gone. And so we've got people who want to be gifting things. So, and you look at the estate tax laws and limitations, different states. Oregon is horrible with the state taxes, all right? So believe it or not, you're better off dying in California than you are in Oregon. And these people just get their claws into your money and they think it's theirs, or they have some right to it. I mean, think about the world. You pay tax on money when you buy it. A lot of things you pay tax on when you buy it. If you've got real estate, you're paying tax on it during the time you own it. You sell it, you got to pay tax again. Then when you die, you got to pay tax again. And then you got other things, you're paying tax on everything you're maintaining. So how much tax do they think they really are entitled to? It's just nuts. So the old saying, death and taxes, two sureties in life. But this gifting situation, we have a lot of people that will be gifting interest in their states to get the value of the state to a level which reduces their tax consequence. And that, once again, good tax attorneys, talk to good financial advisors. They're going to be working with you and work through that stuff. Take advantage of the resources you got there. Okay, so gifting is a great opportunity there. Opportunity zones, fail 1031. A QOZ is a great thing. Maybe you don't want to do an exchange. The OZ is a great opportunity there. Great projects out there. I'm going to say once again, what good is tax deferral if what you buy doesn't work out? So, don't do an exchange into something that's a garbage investment property, because you might have deferred tax, but what you bought, you lost it all on. So, once again, you got to be working with people that have been doing this stuff. Understand that investment's only as good as those people providing that investment. Those builder developers have better be people that have been doing it. Understand the background of those people that you're working with in that situation. Exchange until it makes tax sense. Once again, offsetting losses with gains. Maybe you don't want to pay the tax this year, maybe you next year. More frequent and smaller transactions. Why that? If we're looking at a situation, let's say they did say, okay, 1031, we're going to put a cap on annual deferral. So right now it's unlimited, defer as much. You sold $100 million worth of stuff this year, you can do an exchange on all of it. There was a proposal, like I said at the beginning, where if Democrats had won, we were looking at a $500,000 deferral per person per year. So any exchange in excess of the $500,000 would have been taxable. So maybe instead of taking and exchanging out of and into one big thing, maybe you're breaking it into little pieces and holding those things. And maybe as you sell those, maybe the gain on each of those is okay, and you don't mind paying the tax, you don't do exchanges. Or if in the future they did implement a cap, let's say, you would have those smaller assets, smaller gains, and you've got the ability to do what you want with those things. The downside of breaking and fragmenting a big investment into multiple investments is that when those things go full cycle for you, it's really hard to aggregate all of them back into one big thing again. That's it. Please like and subscribe. Take a look at the stuff, our YouTube stuff. I try to have fun with it. We try to get useful information out there. It really helps us out when you like and subscribe those things. Follow our social media stuff. Stay on top of what news, what's going on in our world. We're going to be putting some big events together. Okay, so I'm going to have a lot of fun this year. We're going to put a couple of big events together. We're going to have, events with oil and gas stuff. We're going to have events with DST stuff. We're going to have events with multifamily appraisers, economists, things that hopefully will be very useful to you. And information is power. So we want to make sure we're arming our clients with as much information as possible to help you get where you want to go and be educated getting through this life, so you can have a lot of fun. Fun is the best thing to have. You can take a look at IRAadvantage.com or .net for our retirement stuff. 1031exchange.com, obviously, for 1031s. If you got property or some opportunity you want to get in front of people, you can take a look at Post 1031. There's paid and complimentary listings there. But thank you so much for attending today. If you want to reach out or you need CE, reach out to Seymour at 1031exchange.com. And all my best to everybody out there. And sorry, I spoke quickly. It took us about a half hour more than I wanted, but hey, we're done. So thank you, all my best, and look forward to speaking with you soon. David Moore, Equity Advantage, signing off. Bye-bye.